passive index funds have overtaken active funds for the very first time. This is the ICI's annual report. 16% of U.S. market capitalization was controlled by passive funds at the end of 2021, 14% for active funds. This is the first time passive has got a stronger market share than active. You run one of the biggest active bond funds in the U.S. How do you feel about this relentless flow of money into passive funds?
Well, it's really driven by two things. One is tax loss harvesting, as we mentioned at the outset. There's a tremendous amount of mutual fund money that is being simply creating tax losses that's rotating out into other fixed income investments that are more generic. Frankly, you're seeing a lot of inflows into government bond funds of all different types of durations. And so that in and of itself is part of that tactical nature. But what's inevitably happened in periods of uncertainty in the past is those initial allocations get redeployed. And the risk of those allocations gets underappreciated given the uncertain environments that we're in. And we typically see that those active strategies start to bring in and create a magnet effect for new inflows when that uncertainty emerges, and more importantly, as we get later on in the rate hiking cycle that we've typically seen with the Fed. So the maneuverability of active management and fixed income is unequivocal at this point. But the reality is we're having people make a tactical decision at this point to realize tax loss harvesting, and then going into various strategies which they deem to be more liquid over periods of time. The next step of that is how they choose to manage the more myopic focus of their views of risk, and that's yet to be determined. But we've seen that time and time again over the past 4 to 5 decades. We think it's certainly going to happen this time around. I think also, though, Bob, we need to contextualize this broad conversation. One where is more tactical, meaning over the next 6 to 12 months, which is yields have increased in terms of where the relative opportunities are and how to play defense against broader market volatility. And then one, the secular trend or multi-secular trend, which is we're finding new avenues of people who want to think about fixed income since bonds are different. And that is a inviting base of people who really haven't been focused on, looking away from typical risk assets, including equities, high yield, emerging markets, that really affords them opportunities and avenues to take advantage of the ETF vehicle, something that has been sort of evolving since the category killers like the ultra short funds more than a decade ago. So this is just the natural evolution of the ETF landscape, which is inviting a new clientele into the marketplace. And we're beginning to see that continue, as we have for the past decade, into the next decade. So the growth is going to be tremendous, especially if we find ourselves in a more higher yield environment, similar to where we are today, and more importantly, we're able to differentiate those risks along the way.
There was it's certainly true that there are new elements, new investors coming into the ETF space. That's certainly good news. The problem I have is with this whole active argument. We've been hearing since the dawn of time. Wait till things get really messy, and that's when the active guys are going to outperform. And the academic literature indicates it's not true. Now, Dan, you have been a very vociferous defender.
Okay. Yeah, no, okay. That's not true. I think we have to be very, very clear about the difference between active equities and active fixed income. Active equities, actually, we would agree with that statement that the active underperforms over periods of time, especially when you calculate fees. But undoubtedly, when you look at the fixed income dynamics, whether it's a mutual fund or ETF, active fixed income does outperform in those environments because of its degree of freedoms and maneuverability to manage interest rate exposure, credit exposure, et cetera. All you have to do is look back to the global financial crisis to see that relative outperformance across all different types of bond funds in that context. And that, there's plenty of data that supports that. You can simply go to ETFs.com and find much of it.
Go ahead.
The whole active-passive argument is built on averages. And if you want to buy the average fund manager, then you're in trouble. You're not going to do well. But if you do your homework, you do your research, you find the really good active managers, whether it's in bond funds, whether it's in stock funds, you can outperform. They do outperform. I mean, Bob, you've been reading my newsletter for over 20 years. You've seen what haapens, all right? You go. Well,
you have been a very vociferous defender of Vanguard's active management in that period. Indeed, so is Jack Bogle, who said time after time the average person's better off in a passive index fund, time after time, and then was instrumental in creating active bond and equity ETFs. He created Prime Cap. He created Wellington. I mean, he never had a problem with the idea, but he insisted that the average person is better off in a passive
well,
fund.
his largest holding for years and years was Windsor Fund. It was John Neff's fund.
Yeah.
It wasn't the 500 index fund. So, Jack Bogle, who, I had many conversations with, he could talk the game out of both sides of his mouth. And what happened? Vanguard grew to be as big as it is because, if you bought the active, you went that way. If you bought passive, you went that way.
So Jerome is insisting on active bond management can outperform during periods of high volatility. Where do you come down on all of this?
So what we've seen is that active managers can add some value by taking on credit risk relative to the broader marketplace, and advisors are embracing that. So at Verify, we've done some surveys and done webcasts that talk to advisors to be able to understand it. And what they're telling us is they want an active strategy that can help navigate this environment that we're in, where it's rising interest rates, whether they're worried about credit spreads. They're visiting our Verify website and being able to learn more about these tools, and they're embracing these active strategies from PIMCO, among others. They're really punching above their weight this year.
Yeah.
We're running a tactical high yield portfolio at Advisor Investments with a couple of different sleeves, and it's it's a very interesting way to approach the high yield market because obviously the spreads change so quickly.
And we were talking about that Vanguard. That's the one area that Vanguard does not have an index-based approach within the ETF structure. They've got actively managed mutual funds within high yield, but we're seeing advisors embracing high yield again. You showed earlier HYG was one of the more popular funds in the data that we have at Verify, and we're seeing that investors are embracing these fixed income ETFs and comfortable taking on a more active approach using these products.
Yeah. So what happens now if we continue to see days like today, where yields, we're over 3% on the 10-year at this point? Will this still result in fund outflows, if this continues?
So from an ETF perspective, we think we're going to continue to see investors embrace the structure. From a mutual fund standpoint, I think if you've got losses that are around 9% in the average bond mutual fund, you're going to likely look to take that tax loss harvesting that Dan was talking about earlier and be able to benefit from a lower cost, more liquid alternative that you can find through the ETF structure.
Okay. Jerome, now you have said before 25% you think of fixed income flows will likely go to active strategies this year. You're talking about 4 to 5 trillion going into bond ETFs over the next 8 to 10 years. So 25% is a pretty good number.
Yeah, and I think it goes with the evolution and education of the value of the bond ETF and the bond landscape. Remember, here at PIMCO, we're really vehicle agnostic in many ways. What we're looking for is to try to find ways to differentiate and accentuate risk parameters, which effectively bring total return to clients, and that is active management. So what we're ultimately saying here is that over the next few years, the new people, the new advisors, the new clientele who are utilizing the fixed income approach via the active ETFs, via ETFs, are going to quickly see the differentiation that comes from being in a passive versus being in an active. That takes time. So first point, there is tremendous growth. There's $4 to $5 trillion over the next 8 to 10 years that will find its way into that fixed income ETF landscape. And we think a substantive portion of that will ultimately find its way into the active landscape as folks look for differentiation to outperform an economic cycle.
Dan, I want to let me just throw out to the group as a whole. Maybe, Jerome, you can comment on this. I've heard it said often there's no Fed put in equities anymore, that there is, or maybe if there is, it's very, very low, that the Fed's not going to come to the rescue of the stock market if it's down significantly. But I've heard people say there is a Fed put in the bond market, that the Fed cannot allow the bond market to fall apart, yields to go too high, because the funding cost to the U.S. government will be so astronomical. You see different numbers of the cost, if it's 5%, 10-year, 6%, whatever. But whatever, the federal government will be very uncomfortable with yields, in the mid-single digits and the high single digits at this point. Is there such a thing as a Fed put in bonds?
I don't know if there's a Fed put on bonds, but if you think about 2008, I mean, what was going on in the bond market and the liquidity problems, Nobody wants to see that happen again. I mean, the bond market locked up, the cash market locked up. Excuse me. So, is there Fed put? I think they're very concerned. Look, what are the issues today? Inflation, recession, COVID. I mean, it hasn't changed. It's been going on since the beginning of the year. And that's what the Fed is going to be looking at.
Yeah.
I think what we're seeing is advisors are reading their tea leaves from the Fed, being able to give an indication as to whether or not they're more comfortable being hawkish or dovish. And it's something that we're seeing when we talk to advisors at Verify. They're watching what's going on from the Fed, and week to week, month to month, they're shifting their exposure and their comfort from taking on interest rate sensitivity or not, based on whether or not the Fed is going to take more aggressive action.
Yeah. So, Jerome, is there a Fed put in bonds? Is there a reason why the Fed should be uncomfortable if yields really start moving up for funding purposes for the U.S. deficit?
Well, I think what we need to be clear here is the initial discussion of liquidity of markets. And the Fed clearly has cut off the tails of the liquidity of markets in regard to making sure that fundamental liquidity is available in the repo market, and more importantly, trying to create mechanisms to make sure primary dealers are going to still be incentivized to take down primary issuance. So that's been the real focal point of the Fed, really, and it's been highlighted since 2018, 2020, and even more recently. The Fed is very involved in terms of how the market will conduct itself and make sure there's ample liquidity to do so. However, what you're suggesting, though, is that the Federal Reserve will act in conjunction with the Treasury Department, being concerned about overall debt ceiling or debt financing as a percentage of GDP, perhaps. And that seems unlikely. Their job is to be two, perhaps three mandates: growth, inflation, and maybe financial conditions, if you want to throw the third one in there unofficially. But the point is the only way they get to that mid single digit of rates that you're suggesting is if one of those becomes vastly unhinged, much beyond expectations. And that, I would suggest, would probably be inflation, if anything, although that's a low probability event from where we sit right here. So the real concern and the pivot, the inertia that we're seeing with the pivot right now, really has to do with the context of financial conditions moving from easy to tighter, and naturally right now on a historical basis is sort of at the median. And so there's a long way for the Fed actually to continue, quote, tightening, and that's probably going to have more of an effect on the equity market, creating more uncertainty in terms of risk assets, which pivots people more into the fixed income markets. So right now, advisors, risk takers, practitioners are really focused on, if you will, the economics and the cycle as it relates to risk assets and not necessarily bond yields.
Yeah. I think that you made an important distinction between the Fed and the Treasury Department and what their various interests are. However, in the back of the Fed's mind, I'm sure that issue does live there, even if it's not officially part of the mandate here.